Hello folks, this is Chip Hutchison with Hutchison Group with the March 2015 Educational Economic Update. In this month's video, we'll talk about some of the major economic events that occurred last month to give you some insight on what they may mean to you as an investor. Please stay tuned at the end for a required disclosure statement. Let's get started. Interest rates and the Federal Reserve dominated the economic headlines last month. Now, to support the economy, since 2008, the Fed has kept interest rates at historically low levels. The last move they made was to cease the bond buying operations in October. The next move will be to start slowly raising the interest rates to quote-unquote normal levels to prevent inflation from getting out of hand. Now, after the March Open Market Committee, Fed Chair Janet Yellen announced that the Fed is moving away from the patient interest rate investment policy and will start thinking about raising rates later this year. Now, we don't have a date just yet, but many analysts feel like the rate hikes could come as early as mid-June. And this is what gets a lot of investors nervous. Higher interest rates can have an effect on the markets. But we know the Fed is going to be very careful about avoiding damaging the economy. Now, speaking of the economy, we also got to look at the fourth quarter gross domestic product reading, which showed that the economy cooled in the last 3 months of 2014. It grew at just 2.2%. This brings the overall 2014 economic growth to 2.4%, which is up from 2013. Which was at 2.2%. Now, investors care about GDP because it's our most comprehensive and economic scorecard that shows at a glance how the economy is doing. Though the relationship isn't simple, healthy economic growth generally translates into strong corporate profits. Strong corporate profits, with everything being equal, usually boost the markets. Now, digging deeper into the data, we see that strong consumer spending, exports, and business investment supported the economy last year. But the growth rate decreased because of higher imports and lower federal government spending. Now, to translate all this into plain English for you, the economy was fundamentally on very stable footing at the end of the year. Though we don't have our first quarter GDP numbers in for 2015, clearly, the Fed feels comfortable enough about the economy to think about taking away the training wheels. Now, looking ahead at as this first quarter ended, investors will turn their attention to corporate earnings. These reports to help us understand how the U.S. companies are performing. Right now, the overall expectations are lower because of weak overseas demand, low oil prices, and the cold winter. But since leadership teams tend to under-promise and over-deliver, we can hope for some positive earnings surprises soon. We'll know in the next few weeks. Now, that's it for our March Educational Economic Update. So as always, if you have any questions or concerns at all about anything we've discussed, please give us a call. Once again, this is Chip Hutchison with Hutchison Group, signing off for March 2015. Please remember that nothing we talk about here is a recommendation. If you would like to discuss your personal financial situation, give us a call at 985-2447. We'll be happy to talk to you. Now, while we believe the information in this report is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or a solicitation for the purchase or sale of any security. Please consult your financial professional before making any investment decision. Thank you.